Hello, ladies and gentlemen. This is Thomas Fross with Fross and Fross Wealth Management, where, as always, we at least attempt to be the voice of reason in a world full of the pundits of pessimism and the wall of worry. So, lately, there's been quite a bit of talk about how the economy seems to be slowing, and at the same time, prices continue to rise. This combination, often referred to as stagflation, is something, fortunately, we've not seen since the 1970s. So, understandably, many investors, especially retirees, are concerned about what this could mean for both their savings and for their investments. So, what's exactly happening? Well, several factors are creating uncertainty in the markets. Number one, rising costs. Prices for everyday goods like food, gasoline, utilities. We've all seen the price of eggs recently. They've been increasing, which has been squeezing many household budgets. Number two, we've seen the economy begin to slow. Key indicators suggest that the economy is cooling, while consumer spending, unfortunately, is dropping, and manufacturing activity is also slowing down. And then on top of it, we've seen stock market volatility kick up as investors are reacting by selling stocks and moving into bonds. Now, unfortunately, this has put the Federal Reserve in a pickle, a tough position. If inflation remains high, then they need to keep interest rates elevated longer than expected, which could slow down the economy even more, which is what they would hope if we see inflation continue to remain high. Now, on the other hand, if growth weakens significantly, they may need to start cutting rates in order to prevent even a deeper downturn. So the question is, what should investors do? Number one, stay focused on the long term. I realize market swings can be unsettling for all of us, but history shows that patience pays off. Avoid making emotional investment decisions. While it's tempting to pull out of the market during downturns, doing so can be very, very costly. Long-term investors win. I'll give you an example. Investors that invested at the beginning of 2007 in the S&P 500, who stayed invested for the following 6 years, and they saw their investments really tank from '07 through '09 during the financial crisis, but they did not sell at the bottom. They maintained their investments. By 2013, they saw their average account balances increase by 86%. Once again, why? Because they didn't emotionally react and sell at the bottom. Number two, review your portfolio. This is a great time to ensure that your investments align with your risk tolerance and also, maybe more importantly, your income needs. Conservative strategies can help protect your wealth as well. That leads us to the third. Consider fixed income options. With treasury yields finally higher than they've been since 2008, bonds and CDs could provide stable income with less risk. And number four, have a plan for inflation. Rising prices can erode purchasing power, but stocks over time have consistently been a good hedge against inflation. So in conclusion, while the economy faces challenges, no doubt, retirees who stay disciplined and diversified will be in the best position to navigate uncertainty. We also encourage you to tune out the news or the noise, however you want to call it. Yes, we may have tariffs. That very well may happen, and that could also impact inflation. But we encourage you to maintain a long view. And if you're unsure about your current strategy, now is a great time to review your financial plan. So on behalf of all of us here at Fross and Fross Wealth Management, thank you very much for the trust that you've placed in us. If you have any questions, please feel free to reach out. 352-205-7800. Have a wonderful day.